What if I told you that every time you take a loan, every time you swipe your credit card, every time your bank approves a mortgage, money is created, not transferred, not moved, but created from nothing? And what if I told you that this invisible process has shaped every war, every boom, every crash, and even the way you think about your own wealth? In this episode, we're not talking about conspiracy. We're talking about the cold, mechanical reality of the modern financial system and the hidden architecture that allows private banks to literally create money out of thin air. It's a story of deception hidden in plain sight, a system that rewards debt, punishes discipline, and silently enslaves entire nations through credit. But to understand how it all works, we have to go back to the moment money stopped being real. Before banks became the magicians of money creation, money was something tangible. A gold coin, a silver bar, something that could be touched, weighed, and stored. For thousands of years, trade depended on scarcity. A coin had value because the metal it contained had value. If you wanted to lend money, you had to have it first. This system, though primitive, had one advantage. Trust was built on reality. But reality, as it turns out, was inconvenient. In ancient Babylon, around 2000 BC, the first banking records emerged, clay tablets detailing loans of grain and silver. Even then, a powerful idea was forming: money as a promise, not a possession. Fast forward to medieval Europe. Goldsmiths, the safekeepers of precious metals, began issuing paper receipts. These receipts represented gold stored in their vaults. They were convenient, portable, and soon people began trading the paper itself instead of the gold. That was the turning point. Because once people trusted the paper more than the goldsmiths realized something revolutionary and dangerous. They noticed that not everyone came to withdraw their gold at the same time. So they thought, what if we lend out more paper receipts than the gold we actually hold? That was the birth of fractional reserve banking, the system that still rules your life today. One act of human convenience, lending more promises than gold, became the seed of the global financial illusion. By the 17th century, this system evolved into formal banking. England's Bank of England, founded in 1694, became the prototype. King William III needed money for war against France. But the government was broke. So private bankers offered him a deal. They would create the money he needed by issuing government bonds, essentially IOUs, in exchange for interest-bearing notes. It worked like alchemy. Suddenly, the kingdom had money to fight a war, without actually having it. The Bank of England printed notes based on debt, and those notes circulated as currency. The state endorsed it, the people accepted it, and the illusion became law. Every major power took notice. France, the Netherlands, then the United States, all followed. The principle was clear. Money no longer needed to exist before being spent. It could be created through debt. This was not a bug in the system. This was the system. The United States, founded on rebellion against monarchy and debt, ironically fell into the same trap. In 1791, the first Bank of the United States was created, modeled after the Bank of England. Alexander Hamilton, the first Secretary of the Treasury, believed a central bank would stabilize the economy. But Thomas Jefferson warned, banking establishments are more dangerous than standing armies. He was right. That first bank expired after 20 years. Then came the Second Bank of the United States, another experiment in centralized control. By the 1830s, President Andrew Jackson waged war against it. He accused bankers of corruption and manipulation. Jackson famously said, "You are a den of vipers and thieves. I intend to rout you out, and by the eternal God, I will rout you out." He did. The bank was dismantled. For a time, America returned to sound money, gold and silver. But the victory was temporary. By the late 19th century, industrialization demanded more capital. The nation's gold supply simply couldn't keep up with the economy's expansion. The pressure built until 1913, when a new plan quietly passed under President Woodrow Wilson. That plan created the Federal Reserve System. Few people knew what it truly meant, because the Federal Reserve was not entirely federal, and it had no real reserves. It was, and still is, a network of private banks empowered to create money through lending. The illusion had become institutionalized. Here's where things get interesting and uncomfortable. Most people believe the government prints money. But in reality, commercial banks create the majority of money, not the government, not the central bank. Here's how the magic trick works. When you go to a bank for a loan, say $10,000, you assume that money comes from someone else's savings. It doesn't. The bank simply types $10,000 into your account. That number didn't exist before. It wasn't transferred. It was created. The bank records it as both an asset, the loan, and a liability, your deposit. That's it. A few keystrokes. And new money enters circulation. This process is called fractional reserve lending. Banks keep only a small fraction of deposits as reserves, sometimes as low as 0% in modern systems, and lend out the rest many times over. For example, a customer deposits $1,000. The bank keeps $100 and lends $900 to another borrower. That $900, when spent, ends up deposited somewhere else, and 90% of it is lent again. The process repeats. By the end, the original $1,000 has multiplied into $10,000 of total money in the system. But here's the catch. The interest owed on all that new money was never created. So to keep the system alive, more loans must be created to pay off the previous ones. Debt must grow forever. And that's why the world's total debt always exceeds the total money supply. Money is debt. For a while, gold acted as the anchor, the limit that prevented infinite expansion. But that anchor snapped in 1971. President Richard Nixon announced the suspension of the gold standard, ending the convertibility of US dollars into gold. It was called temporary. It became permanent. From that moment, the dollar was backed by nothing but government decree, Fiat. And so, banks were free to expand credit endlessly, with no restraint from physical reality. Global debt exploded. In 1971, total U.S. debt stood at $1.6 trillion. By 2025, it exceeds $100 trillion and counting. Every boom, every crash, every bailout since traces back to that moment. With no gold limits, banking entered its golden age. In the 1980s and 90s, deregulation and financial engineering made credit creation more profitable than ever. Derivatives, mortgage-backed securities, shadow banking, complex names for one simple reality, creating more claims on money than real wealth existed. When banks lend recklessly, they earn massive profits during the boom. When it collapses, central banks rescue them with newly created money, and the cycle begins again. This culminated in the 2008 financial crisis. Lehman Brothers, AIG, and dozens of institutions imploded when the illusion cracked. Trillions in assets vanished overnight, not because the money was stolen or destroyed, but because it was never real to begin with. The response? Even more money creation. The Federal Reserve launched quantitative easing, buying government bonds and mortgage securities with money that didn't exist the day before. Between 2008 and 2022, the Fed created over $8 trillion out of nothing. And yet, the average person didn't get richer. Prices rose, debt soared, inequality widened. Because when money is created through debt, those closest to the creation point, banks, corporations, and governments, benefit first. Everyone else pays later through inflation. This is called the Cantillon effect, the silent wealth transfer mechanism of modern finance. Today, most people believe they have money in the bank. But in truth, what you have is a bank's promise, a digital IOU. If everyone withdrew their deposits tomorrow, the system would collapse instantly. Because the money isn't there. It was never there. Even central banks now admit this openly. In 2014, the Bank of England published a paper titled Money Creation in the Modern Economy. It confirmed that The majority of money in circulation is created by commercial banks through lending. The illusion is not a secret anymore. It's public knowledge, but still widely ignored. We now live in a world where money is not a measure of value, but a measure of debt. Let's look at the numbers. As of 2025, global debt exceeds $315 trillion. Global GDP stands around $110 trillion, meaning the world owes 3 times more money than exists in goods and services. Every dollar, euro, or yen is born from someone else's liability. In 2020, during the pandemic, central banks created over $9 trillion in a single year. The result? Inflation surged to multi-decade highs. Housing became unaffordable. And yet, financial markets hit record levels. This wasn't growth, it was dilution. Money creation benefits those who receive it first, banks and governments, while eroding the purchasing power of those who receive it last, the working class. That's why billionaires' wealth rose by $5 trillion during the pandemic, while real wages stagnated. The system isn't broken, it's working exactly as designed. Now a new form of money is emerging: central bank digital currencies, or CBDCs. Governments argue they will make transactions safer and more efficient. But beneath the surface lies a deeper shift: absolute control. In a CBDC world, every unit of money can be tracked, restricted, or expired. If money is programmable, then freedom becomes conditional. And once physical cash disappears, every transaction will pass through digital gateways controlled by central authorities. It's the logical conclusion of a system where money was never real, only permitted. Throughout history, every fiat currency has failed. From ancient Rome's debased denarius, to France's assignats, to Germany's Weimar mark, the story is always the same. When money becomes unlimited, discipline disappears. Governments spend recklessly, banks lend excessively, and ordinary people pay the price through inflation and lost savings. The cycle repeats until trust collapses. Then a new system emerges, usually backed by something real, until greed erodes it again. The cracks are visible again. The US debt grows by $1 trillion every 100 days. Interest payments on that debt now exceed military spending. Over 60% of Americans live paycheck to paycheck, despite the largest money supply in history. And banks are once again leveraged at dangerous levels. We're watching the endgame of exponential debt, a system consuming itself. Because when every dollar is debt, and debt must always grow, stability becomes mathematically impossible. After centuries of this cycle, 3 truths remain. 1. Money is not wealth. Money is merely a claim on real goods and services. When banks create more claims than reality can provide, collapse becomes inevitable. 2. Debt is the engine of the system. The economy's growth depends on perpetual borrowing, but debt-based growth is unsustainable. It demands infinite expansion on a finite planet. 3. Trust is the real currency. When trust in money fades, no paper, coin, or digital code can replace it. History shows every empire falls not when it runs out of gold, but when it runs out of trust. The phrase, money out of thin air, isn't poetic, it's literal. Every dollar, every credit, every digital balance was summoned through debt, obligation, and trust in a system that no longer remembers what real value means. The illusion can persist only as long as people believe in it. But belief, like credit, has limits. When those limits break, as they always do, what's left is not chaos, but clarity. A reminder that true wealth was never digits in a bank. It's knowledge, it's production. It's trust between people, not institutions. As we stand on the edge of another financial reset, the question isn't, will the system survive? It's, what will replace it? Maybe it will be digital, maybe decentralized, maybe something entirely new. But one thing is certain, until we understand how money is created, we'll always serve those who create it. So next time you see numbers appear in your account, remember, that's not wealth, that's faith, temporarily digitized. Money is an illusion, but understanding it is power. If you found this video eye-opening, don't forget to subscribe to the Fiscal Archivist for more deep dives into the hidden mechanics of finance and power. Share this story, because truth only matters if it spreads. And remember, question everything that feels normal in money, because that's usually where the illusion hides.